Across Canada, homes that were snapped up by investors just a few years ago are starting to hit the market again. The headlines don't scream it yet, but the numbers tell a different story. Investors are quietly unloading properties, and the reasons should make every homeowner pay attention. In the next 5 minutes, we'll break down what's driving these stealth sales, the signs showing up in markets like Toronto, Vancouver, and Calgary, and what it all means if you're buying, selling, or just waiting on the sidelines. Number 1. Interest rate shock. Many investors bought during the pandemic when rates were at record lows. A mortgage that once cost $2,000 a month can now be closer to $4,000. Variable rate borrowers feel it instantly, but even fixed-rate owners face painful renewals when rent increases can't keep pace with rising payments. Holding that investment property turns into a monthly cash drain. For some, selling quietly before the next renewal feels safer than gambling on rates coming down fast. Number 2. New tax rules. The federal government recently hiked the inclusion rate on capital gains for high earners starting in 2025. That means more of the profit from selling a rental or a second home will be taxable. Investors who were already thinking about cashing out now face a deadline. Add in provincial vacancy taxes, speculation levies in British Columbia, and stricter reporting to the CRA, and suddenly the math on holding long-term isn't as sweet as it looked in 2021. Number 3. Rent growth is cooling. During the pandemic boom, landlords could raise rents 10 to 20% in some cities and still fill units. But in 2024 and 2025, supply is catching up in pockets of Ontario and Alberta. With new apartment buildings opening and renters hitting affordability limits, bidding wars for leases are less common. Investors who counted on endless rent hikes to cover bigger mortgages are realizing the ceiling is lower than they hoped. Number 4. Market psychology. Investors watch each other closely. When a few start selling, others follow to avoid being the last one out. Real estate is emotional, even for the so-called pros. A neighbors for sale sign can spread doubt faster than a Bank of Canada press release. That fear of being stuck when prices dip, even slightly, pushes some to list properties quietly, hoping to capture peak value while headlines remain calm. Number 5. Opportunity and risk for everyday Canadians. If you're a first-time buyer, more investor listings can mean slightly more choice and less bidding war chaos. But don't expect a 2008-style crash. Canada still faces chronic housing shortages, immigration-driven demand, and tight construction supply. For homeowners, it's a reminder to stress test your own mortgage and avoid stretching for that next property just because real estate always goes up. Canadian investors aren't panicking out loud, but their quiet selling tells the real story. Higher rates, new taxes, and changing psychology are reshaping the market right now. Stay informed, stay patient, and if you found this breakdown useful, hit subscribe and share it with someone watching the housing market as closely as you are.